Let me ask you something. If I told you there was an investment that pays you a fixed amount of money every single month, guaranteed, no matter what the stock market does, would you be interested? Most people say yes. And then I tell them it's called a bond, and suddenly they lose interest. Bonds are boring. Bonds are for old people. Bonds are what my grandfather bought. Here is the truth. Bonds are one of the most powerful tools in the history of finance. And the people who say they are boring are usually the people who don't understand them. Today, we are going to fix that. So what exactly is a bond? Think of it this way. Imagine your friend needs to borrow $10,000. He comes to you and says, I need this money for 5 years. In exchange, I will pay you 5% interest every year. And at the end of 5 years, I give you your $10,000 back. You agree. You give him the money. He gives you a piece of paper that says, I owe you $10,000, I will pay you $500 every year, and I will pay you back in full in 2031. That piece of paper is a bond. Now, instead of your friend, imagine it is the United States government asking to borrow money, or Apple, or Toyota, or the city of New York. They need money to build roads, develop new products, pay their employees, so they issue bonds. They sell them to investors like you and me, and in exchange, they promise to pay us interest, called a coupon, on a regular schedule, and to return our full investment at the end of the bond's life, called the maturity date. That is all a bond is, a loan. You are the bank. They are the borrower. Now let us talk about the 3 numbers you need to understand every time you look at a bond. Number 1, the face value, also called par value. This is the amount the bond will pay you back at maturity, usually $1,000 per bond. This is your principal, the money you get back at the end. Number 2, the coupon rate. This is the annual interest rate the bond pays you. If a bond has a face value of $1,000 and a coupon rate of 5%, that means you receive $50 per year, usually paid in 2 installments of $25 every 6 months, like clockwork, every year, until the bond matures. Number 3, the maturity date. This is when the bond expires and you get your face value back. Bonds can mature in as little as 3 months. Those are called treasury bills, or as long as 30 years. A 30-year U.S. Treasury bond issued today will pay you interest every 6 months until 2055 and then return your full principal. Now here is where it gets interesting, and this is the part that confuses most people. Bonds have a fixed coupon rate, but their price on the market moves every single day. And there is an iron rule in the bond market that you must tattoo on your brain. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. They always move in opposite directions. Always. Here is why. Imagine you bought a bond last year that pays 5% interest. Today, the Federal Reserve raises interest rates and new bonds are being issued at 7%. Why would anyone buy your old 5% bond when they can get a brand new 7% bond? They would not. So the price of your bond drops until it becomes cheap enough that the effective return equals 7%. The bond did not change. The market around it changed. This is why bond investors watch the Federal Reserve so closely. Every time the Fed raises or cuts rates, the entire bond market moves. Now let us talk about risk, because not all bonds are created equal. At one end of the spectrum, you have government bonds. In the United States, these are called treasuries. When you buy a U.S. Treasury bond, you are lending money to the American government. The risk of default, of not getting paid back, is considered essentially zero. The U.S. government has never defaulted on its debt in modern history. In exchange for this safety, treasuries pay lower interest rates. At the other end of the spectrum, you have corporate bonds. When Apple or Tesla or Amazon needs to raise money, they issue bonds. A financially strong company like Apple will pay a slightly higher rate than the U.S. government, maybe 0.5% more, because there is slightly more risk. But a smaller, riskier company might need to pay 5 or 6% more than treasuries to attract investors. These are called high-yield bonds, or more colorfully, junk bonds. The rating agencies, Moody's, Standard & Poor's, Fitch, grade bonds from AAA at the top, which means extremely safe, all the way down to D, which means the company has already defaulted. The lower the rating, the higher the interest rate, Because investors demand more reward for taking more risk. So why would you own bonds? 3 reasons. First, income. Bonds pay you a predictable, regular income. If you have $100,000 in bonds at 5%, you receive $5,000 per year in interest payments. No matter what the stock market does, no matter if the economy is booming or crashing, the coupon keeps coming. Second, stability. When stock markets crash, investors often flee to bonds. In 2008, when the stock market lost 50% of its value, U.S. Treasury bonds went up in price. Bonds act as a shock absorber in a portfolio. They do not eliminate risk, but they reduce volatility dramatically. Third, diversification. The smartest investors in the world do not put all their money in stocks. They mix stocks and bonds in a ratio that matches their risk tolerance and their time horizon. A classic allocation is 60% stocks and 40% bonds, giving you growth potential from stocks and stability from bonds. Here is what you need to remember. A bond is a loan you make to a government or a company. They pay you interest, the coupon, on a regular schedule. At the end of the bond's life, the maturity date, they return your full principal. Bond prices move inversely to interest rates. Government bonds are safer but pay less. Corporate bonds pay more but carry more risk. Bonds are not boring. Bonds are the foundation of the global financial system. Every pension fund, every sovereign wealth fund, every insurance company in the world holds bonds. They are the instrument that keeps the economy running. And now you understand them. Subscribe to Investopia for more daily finance content that actually explains how money works. The next video is coming soon. Do not miss it.